Good afternoon, everyone, and welcome to this latest Kepler Trust Intelligence event. The theme for the week is alternatives for income investors. Shortly, we'll be hearing from Adam English, manager of M&G Credit Income Investment Trust, to kick us off. M&G Credit Income pays a dividend linked to interest rates with a target of SONIA plus 4% over the course of the year. Clearly, that's potentially a very attractive feature in the current rates environment. Before Adam gets going, just a reminder that if you'd like to ask him a question, you should be able to do so in the box on the right of your screen. We have about 15 minutes saved for questions at the end of the presentation, so please put your questions there and we'll put them to Adam at the end. So with that, I will hand over to Adam.
Great, thank you, Thomas. So I'll tell you about the Credit Income Investment Trust in a minute, but let me just give a few words of introduction for myself. I've been working for M&G as a money manager for over 20 years. Over that time, I've been managing money on the fixed income side for our internal insurance clients. So that's the Prudential, your Prudential UK business, you'll know. And through that time, excuse me, we have had we've shown very strong performance on a 16 billion sterling portfolio, and the reason we've had that very good performance is that we've been following strategies involving bottom-up stock picking, having a somewhat counter-cyclical approach to investing in fixed income markets, and adding diversification through buying private and illiquid assets. And really, that was the genesis of this investment trust. Is we thought we would open up this kind of strategy, which has been very successful over the last 20 years, to non-large institutional investors, to the type of investors who can buy investment trusts. And so that is what I've been doing also for the last 4.5 years. I've been managing the M&G Credit Income Investment Trust since November 2018. So with that, I'll just move on and tell you a little bit more about the trust itself. As Thomas said, the M&G Credit Income Investment Trust is a floating rate structure. So what it does, it pays dividends based upon floating interest rates. SONIA is the benchmark we use, but SONIA is an index which is essentially moves in line with Bank of England base rates. So we pay this SONIA rate plus 4%, which post the Bank of England's moving base rates up again last week, that equates to a yield of around 8.5%. And the reason we can do that is we have an underlying asset base of largely floating rate assets as well. So what happens is as the Bank of England raises rates, the returns on these underlying assets go up, they pay a higher coupon to us, and we simply pass that through as a higher dividend to end investors. The other key point about this trust is its investment grade quality. So what that means is it predominantly invests in investment grade credit assets. These are generally lower risk, have a low risk of default, and exhibit lower volatility. And indeed, the M&G Credit Income Investment Trust is the only investment trust in the fixed income space which is investment grade, which has this low underlying risk, which has this investment grade quality within it. So put those two together, we have a low net asset volatility. And that is because we have these good quality assets, these investment grade assets within the portfolio, and we have low interest rate exposure because of this floating rate structure, which means essentially as interest rates go up, our return goes up, rather than many fixed income assets where interest rates go up, the value of those investments actually go down. So all that points towards a low net asset value volatility. And so how do we do this? How do we get such a great return, but with relatively low volatility, relatively high quality assets? Well, we do that by investing in private and illiquid credit assets. So these are assets which are generally difficult to source, difficult to analyze, and take some time to structure. And in return for all this additional work we have, we get paid more. So we get paid a greater return than you would expect in a public investment grade portfolio. And the reason we can do that is we have a huge wealth of experience at M&G. M&G has 130 analysts across the private and the public fixed income markets. And so what they're doing is they're constantly analyzing whatever is available in their end markets, and they're bringing to me their ideas, and I can then cherry pick the best risk return available at any one time and build a portfolio from there. So the idea here is I'm not seeking to select assets just because I've said that these are the asset classes I want to invest in. I'm just investing in the best assets available at any one time. And so the end result here is that we're paying a cash plus return, which is at the moment around 8.5%. If the Bank of England increases base rates again, then that will go up further, but with a relatively low volatility net asset value portfolio underneath. Essentially, what we're providing is a return which is more akin to a high yield, a floating rates high yield return, but with an investment grade underlying asset. So let me just flesh out some of those points. I've got a rather busy graph here, but just suffice to say, our net assets value, our return here is in the yellow line. And we have a number of fixed income indices which we compare ourselves against. So first off, we have the red and the purple lines, which are interest sensitive investment grade indices. And you can see they perform relatively well, particularly in times of economic stress, like after the COVID crisis. But in times of increasing interest rates, they suffer because their asset value generally goes down as interest rates go up. Conversely, we have two floating rate indices, which are high yields. There's a loan index and a high yield floating rate index. These tend to perform well as their floating rate in times of rising interest rates, but they suffer volatility in times of economic stress. So you can see they sold off quite significantly at the time of the COVID crisis. And what you can see is the yellow line, the Credit Income Investment Trust, just performs very well compared to all these indices because it has inherently a lower volatility underlying portfolio base. And I should add, actually, the indices here I'm showing as a gross return, and I'm showing the investment trust as a net return. So if I were actually to give the gross returns on the credit income investment trust, it would look even better compared to these alternative fixed income asset classes. So I do think it really does show a very strong proposition through economic cycles. And how do we do it? Well, we're investing in these public and private and illiquid assets. These do give a higher return than investment grade assets. So I've shown the yield on our portfolio here, the red one. The red line is our yield, and the green line is as what an investment grade, sterling investment grade index will return. So you can see we're consistently higher than that, and that's because we have these private and illiquid assets within our portfolio. And you can see it compares very well to high yields. The blue line is high yields, and it shows that we are far closer to what you'd expect for high yield, but with a better quality underlying assets. This is a relatively busy pie chart, but the main point to show here is that 60% of the portfolio is in private assets, and I might add another 13 or 14% is in illiquid assets, which, though they are treated as securities, they're very liquid. I hold them to maturity. So somewhere in the low 70% is in private and illiquid assets, and that's why we get that additional yield in this portfolio. I think the other points to note in this pie chart is just what a diversified underlying portfolio we have. We've got many different types of instruments within the portfolio. So that one diversification is good. We're not beholden to any one particular sector, and nor are we forced into buying into a particular sector because that's what we've said we'll invest in. We're just looking at the best opportunities presented to us at any one time, and then we'll put it into this portfolio. And to flesh out that point a little further, on the right hand, we have a pie chart just showing all the different areas of the fixed income markets we can invest in. So the light blue piece of the pie is the public liquid bond market, which we can invest in, but all the others are private parts of the private fixed income markets. And there will be times when these are more attractive or less attractive, and we can just agnostically invest wherever the best opportunities are. So on the left, I've got a scatter chart here. This changes over the time. It's just here for indication purposes, really. But you can see that at times some of these asset classes will look more attractive. Asset-based lending, the ABL there, complex direct lending, capital relief trades, more attractive. Something like private placements, less attractive right now. But this changes. So private placements were particularly attractive post the COVID crisis, and I was buying them aggressively. Since then, the opportunities in that space have reduced. They aren't giving a return very much more than one would expect in the public liquid bond markets. So there's no need to invest in them. So I don't invest, and then when that asset class becomes attractive again, that's when I'll start investing again. So let me give you a bit more idea of the kind of assets, these private assets we're investing in. The first example I have here is a student loan facility. So this relates to a portfolio of student loans, which relate to students who would have been at university between 2002 and 2008. And the government sold off a large tranche of these loans in 2018. This is a good piece of lending. Clearly, the servicing, the administration of this is effectively done by Her Majesty's government, by HMRC. So we've got we're in a great position there that they will make sure that the payments come through correctly. We're also in a good position whereby these the students are in the process of largely in the process of paying down their loans now. It's been 20 years since they took them out. So we're invested in a tranche, a B tranche, which sits behind a slightly more senior A tranche. And that has been paying down nicely as the students pay off their loans. And that improves our position within the structure. So as a result, the rating has improved. This is a measure of the credit quality of our bonds. So there's an external rating agency, Fitch, who provided a BBB rating when this originally when it was originally shown to us. They've since upgraded it to a single A, and likewise our internal ratings, which are normally a little lower than the public rating agencies. It certainly was in this case. It started off as a BBB minus, and we've since upgraded it to a BBB plus. So we've got an improving credit, nice piece of lending, but the really great point about this is it pays returns in line with inflation. So it pays RPI, the retail price index, plus 1.45%. And the last RPI reset date, the RPI was at 13.5%. So what we're getting here is a very nice piece of lending, single A rated from Fitch, and it's giving us nearly a 15% return. So this is one of the best returns I see in the fixed income markets, and certainly for risk adjusted, it really does stand out. My next example is a high street baker that we lend to. This is a completely bilateral piece of lending. It's just M&G lending to this bakery business. They've been very successful. They've continued to grow. They've shown very strong profitability. They performed extremely well over the COVID crisis as well. So we've got a good history with them, and they're a good record of paying down their debts. We are lending. We're lending to them on a senior basis, so we think there's good security here. We rate it as a B+, which is sub-investment grade, but we do think there's a very strong recovery if there were to be any problem with this loan. And for that, we're getting a very good return. If you tot up the SONIA plus 4.75% return plus the upfront fees, we're getting a return of currently over 10% on this facility. Again, a very attractive piece of lending. The next example, I can't give you the name, unfortunately, because we've not agreed not to hand this out. So we've called it 4X, but it's got nothing to do with the Australian lager. But this is a leasing business. So in Northern Europe, it's a leasing business which provides leases on electronic goods, largely mobile phones. And it's really a competitor product to providing to a phone provider providing a phone within the contract. It actually provides the end customer with a slightly cheaper way of getting access to the product. Again, this is one where we're lending in a tranche, a senior tranche here. So there's a lot of equity behind us, about 35% equity. We've got good covenants here, so we're constantly repricing the portfolio of phones and tablets, and so we have a good idea what our security is. So we're very comfortable with this piece of lending. So we rate this internally as an A- piece of paper, and we are getting a return of Euribor plus 3.25% for that. This is again compares extremely well to the public markets. Currently, for that rating, if you were to go out into public markets, you'd expect something like 2% less return for this type of business. So it really does show the strength of being able to source these types of assets. And again, this is a bilateral facility between the lender and M&G, so no one else has access to this piece of lending. And lastly, this is a property transaction. The property market has somewhat mixed outlook right now, I'd say, but that also gives us the opportunity to find some very attractive pieces of lending with very attractive returns. In this case, the property is a prime location in the City of London. It's an office space. And what the owner of the property is doing is they're refurbishing it, which we're helping to refinance. And they're refurbishing it to good green credentials. And there is a shortage of this kind of office space in the city. So this should, once completed, be a very attractive piece of office space for potential tenants. And so much so that 60% of it has been pre-let to Standard Chartered Bank, a really strong credit, a really strong tenant to have in there. So we think we're in a good position here. We've lent to a mezzanine piece of paper here, which has 28% equity behind us, so good piece of lending. We expect there will be a valuation uplift as well when the refurbishment is completed, and for that we're getting a good return, 11.4%. So that's just to give you a flavour of some of the assets we're investing in. I think you'll agree these are all very good returns compared to their credit quality and what you can obtain in public markets, fixed income public markets. So let's go back to the trust as a whole. What has been delivered? Well, this graph shows our net asset value total return. That's the blue line here. And our benchmark, that SONIA plus 4, is the purple line. We're generally trending around that purple line. You'll notice at times it goes, our net asset values go below and sometimes above that. And that's really what's happening with the pricing in credit markets, which we can't control. But suffice to say, when it's trading below the purple line, it's generally a good time to be taking exposure because we expect there to be reversion above the purple line. You can see during the COVID crisis, the net asset value traded off. That's because credit spreads widened. It was actually a very good time to be buying risk, so that's exactly what we were doing. And we rode the improvement in credit markets through to through to 2021. At that time, we started to reduce our risk somewhat, not because we thought there was something necessarily concerning us, but we just thought that the pricing wasn't so attractive any longer. And indeed, credit spreads did widen, particularly post the emergency budget last September under the Liz Truss government. And so that's exactly what's happened. You can see the performance fell a little bit there, but then that sets us up nicely to add risk at that time and start seeing performance coming through again. So we're very comfortable with returning to that purple line and see this as an attractive time to be taking exposure. I should add that we do take advantage of these opportunities, having a somewhat counter-cyclical approach I did mention earlier. And the counter-cyclical approach meant that we were buying a lot of attractive assets in the middle of the COVID crisis. We were buying a lot of attractive assets in the post the time of the emergency budget back in September. And this really adds a lot of nice performance into the portfolio, this counter-cyclical investment process we have. So let's look at the underlying portfolio. As I mentioned, it's an investment grade portfolio. 78% of the underlying assets are investment grade. The average rating is BBB, which is firmly in the investment grade space. It's a nicely diversified portfolio, 135 different holdings. We have a very strong yield to worst. It's 9.1%. So that means the yield is covering our dividends currently. And we have the modified duration at 1.2. That essentially is saying we have low interest rate sensitivity. So as interest rates rise, the value of the portfolio doesn't go down. Indeed, what that happens is the income in the portfolio goes up. So let's look ahead. There is across all financial markets, I think there is a somewhat mixed picture. And I think this really comes down to inflation, which is clearly running very high, and central banks' responses to that. The central banks are increasing their rates in order to reduce inflation. And this is across developed world economies. And because the central banks are increasing their base rates, that does take some of the some potential growth out of the economy. So that, I would say, creates a little bit of an uncertain outlook economically. Having said that, investment grade credit is looking particularly attractive. This is because it's less sensitive to the economic cycle, but it's also providing a very nice return currently. And the technical elements are also supporting that because there's a fair amount of supply coming into the market, which is keeping the all-in yields at very high levels. And that is supportive for our returns, for the yields we're earning. Given that somewhat mixed economic outlook, there does feel like there's going to be, and there has been, a growing dispersion in performance within European credit. So it is very important to be more selective and have that core fundamental credit analysis to ensure that there aren't undue risks or problem credits being taken on. There is a banking crisis rolling in Europe and in the US at the moment. Clearly in March there was the issues with Credit Suisse. I think the US regional banking turmoil is continuing, to be fair. So volatility was very high back in March. It went away. It feels like it's coming back a little bit more, but it just means that there is potential for volatility in the markets. So the important point here is that we can take advantage of that. Taking advantage of volatility is really bread and butter for this portfolio, and we don't see that as a threat. These are opportunities to invest, and that's exactly what I mentioned in the previous slide in terms of what we were doing post the COVID crisis and post the emergency budget in September. Just to flesh out that point on investment grade, I've got a couple of graphs here. On the left, this is the US yield curve for government bonds, and on the right we have UK gilts. On the US investment grade and UK investment grade bonds. And you can see that we're just at a very attractive all-in yield level right now compared to recent years. So we're getting very attractive returns in public fixed income, in investment grade fixed income. But what makes it even more attractive is the risk adjusted return. So if you translate those returns into what kind of default rates that would have to equate to, it is well in excess of anything seen in history. Even if you looked at the worst examples, generally in the Great Financial Crisis, we're earning far more than you would we're earning so much more than any kind of losses one would expect, even in such a scenario. And by the way, I'm not forecasting that, but if one were to look at it on those terms, it's a very strong risk-adjusted return. So particularly looking here at single A's and triple B risk is looking very good risk return at the moment. And this is in the public markets. And if you add that illiquidity premium for private assets on top, it's becoming even more attractive. I should add, as you go down the credit spectrum, it becomes less clear. If you look at those triple C, the worst quality credit assets, it's not entirely clear from the return you're getting that you're guaranteed to get your money back. So we're shying away from poorer quality credits and sticking with that investment grade portfolio, which is the basis of the portfolio of the Credit Income Investment Trust. So that just leads us on into the outlook. So as I've mentioned, dividends will increase as SONIA increases, and SONIA will increase as Bank of England's rates increase. We're currently paying a dividend rate since Thursday last week. It will be at a rate of 8.5%, and that will increase further if the Bank of England does increase rates again, which to be fair, the market is expecting another rate rise next month. This helps mitigate inflation because clearly the reason the Bank of England is raising its rates is to try to counter inflation. So it is raising rates until inflation starts coming down. So there is something of a mitigation of inflation within the return in this portfolio. And the reason we can do this, well, we can pay this floating rates dividend, is because the majority of the underlying portfolio is indeed floating rate underneath. So we're just passing that through. I mentioned earlier the attractions of the investment grade market, particularly in triple Bs. Triple B public corporates are attractive. I alluded earlier to the crisis within US banks. This has, and indeed Credit Suisse in Europe, and that has led to some more attractive yields appearing in the financial space. So good quality banks and insurance companies are still seeing their yields quite high at the moment, just as a contagion effect from what's happening in US regional banks and Credit Suisse. Through no fault of their own, many of these are very profitable businesses with very strong capital structures. So I see that as an opportunity to take the other side of that and actually to add some risk in those types of businesses. I also mentioned higher quality asset-backed securities tranches. These are effectively portfolios of loans which are then tranched up. And if you look by some of the better quality tranches, they're trading at very attractive levels, very at relatively high levels, looking at the history of where these things have been trading. And again, by looking at the higher quality, again, it reiterates the quality of the underlying portfolio we're building here. I'm continuing to add to private assets where the attractive returns are available. Some of those previous slides are cases in point, and if I continue to see attractive opportunities like those slides, then I'll continue to be adding those into the portfolio. It really adds to the points that we're just looking at wherever the best opportunities are across the public and private fixed income assets classes. Lastly, I'd like to draw your attention to our debt facility. We have a 25 million debt facility, and we use that really to take advantage of market volatility. So when I mentioned previously that we were adding risk at the time of the emergency budget, that was largely undrawn. We drew upon that in order to buy public fixed income assets, good quality assets, generally utility paper, which was trading at all-time wides. Very attractive time to be buying that. That has since performed extremely well, and I've taken profits on those, sold them down, and in doing so, paid down that debt facility. So that is currently fully available, and if any other market volatility should come our way, then we've got the flexibility to take advantage of that and to draw upon that facility to buy cheap assets again. And so I think it's very important to just bear that in mind. We've got this great flexibility in this portfolio. So I think that really is a quick canter through what the M&G Credit Income Investment Trust is. Just to reiterate, we're providing a floating rate return with a dividend based upon SONIA plus 4%, which currently is a rate of around 8.5%, but with relatively stable low volatility assets underneath, which have that investment grade quality, which really sets it apart from other fixed income investment trusts. And with that, I'll hand it back over to Thomas.
Thanks very much, Adam. We have quite a few questions already that have come in, but we've got about 15 minutes for questions. So if you're in the audience, please do put any further questions you have forward. Perhaps we could start with the private investments. So could you give a bit of detail on how they're valued, how often, and how independent those values are?
Sure. So they are valued by our external administrator, State Street. So it's not something we're selecting the prices on. There is a third party going through that pricing. The pricing is a rather complex process. If it's similar to an existing bond, an existing security, then we'll price it off that. If it's something a little bit more esoteric, we'll matrix price it, which means we'll look at what similar sectors, similar seniority, similar rated transactions are pricing in the public market, and we'll price against that. So the idea is that we're trying to price mark to market as close as we can, but clearly there isn't a market to price for these assets. But we are ensuring that we are trying to provide comparability to where to pricing to where a public market would be pricing these assets.
And how does the private market respond to the sort of volatility we've seen in public markets? Does it become more attractive to arrange a deal privately, or does it create more risk aversion, more less willingness to borrow?
Well, it does a bit of both, actually. So when you see market volatility in the public markets, the private markets tend to just take a pause. They'll close because there isn't really a great deal of pricing visibility, and they tend to wait for the public markets to show some stability before the new private assets start coming through. Now there are exceptions to that, because though these are private assets, sometimes certain portfolio managers have to show some liquidity. So you might actually see some very attractive secondary opportunities to buy. Which is exactly what I saw post the COVID crisis. But generally, in terms of new facilities, it takes a bit of time to get going again. But when it does, they're very attractively priced. And that's exactly what I would expect at the moment as well.
You give it a little bit of your outlook, but I guess could you tell us what your expectations are if you have them in terms of interest rates? So do you think we're near a peak? Do you think we might see rate cuts by the end of the year? Do you have a firm outlook?
Well, I always caveat my answers here that we don't provide a forecast. So that's I'm not providing any forecasts here for where I think interest rates are going to go. But I'll give you my feel of where the market is, and really what my job is to look at where the mispricing is and where the best where the best opportunities are in the underlying investments. So with that in mind, I think the Bank of England is getting close to its end, the end of its rate rising cycle. Currently, the market is expecting another rate rise in June, and then it expects rates to start falling in September. Not very quickly, but you might start seeing a cut or two towards the end of the year. So that's what the market's expecting. Um, the market has been consistently bullish on inflation. All I would note is that inflation has tended to be far more sticky than the markets and indeed central banks have expected. And my gut feel is that this will be similar as well, that we may well see the peak in rate rises relatively soon, but the cuts are probably a little bit further off than the market is currently pricing.
And you painted a rather benign outlook for defaults, or at least that they're kind of being fairly compensated. But are we still expecting problems to emerge as a result of this higher rates environment? And if
Yes.
so, are there any sectors that you think are particularly at risk? So you've mentioned the banking sector, but something else that has been brought up in the questions is commercial property, for example.
Yes. Look, I think I think I'm not sanguine on default rates across the board. I'm trying to paint a picture of the better quality credit, investment grade, is looking very well compensated, and where I see a more limited risk of default. Indeed, I do think there is risk of increasing default rates in poorer quality credits. And so that is very much why I'm shying away from that and running a relatively higher percentage in investment grade than I have done in the past. I mean, generally, it's been more like about 28% non-investment grade. It's currently around 22%. And those that I do hold, I think are good facilities, which I'm very comfortable with. But yes, there will be increased defaults undoubtedly. And where are they going to come from? Well, the first point, and I guess it's the obvious point, is going to be the poor or rated areas of credit. So triple C credit is quite clearly going to be where the larger number of defaults are, and to a lesser extent in single B credits. So that's very clear where the defaults are going to come from. In terms of sectors, well, there are defaults happening in US regional banks. So I think poor quality financial businesses are under some stress right now. So I would, and I have concentrated on large financial institutions that I'm comfortable with very good capital bases and good profitability. And I think that's essential in this kind of environment, because that clearly is the first part of the potential trouble. Commercial real estate is an issue as well. I think it's a greater one in the States. Clearly, the regional banking issue has been largely due to their mark-to-market of US Treasuries, of US government bonds. But I think the next issue to hit those banks is going to be just what kind of losses they're looking at in commercial real estate. Commercial real estate is a pretty broad term. It covers all sorts of different assets, and I think So on the first instance, one's got to be very careful within the portfolio. So this is something I am looking at all the time to try to ensure that we have good quality assets, but it also presents opportunities because everyone knows there is an issue with that sector and there's an issue with banks. So the banks don't want to be lending to commercial real estate. So one can obtain some very good returns in that sector. And my last slide was a commercial real estate transaction. There was an office space within the City of London. That return would not have been available if it had been just even a few years ago. That's because of the reason that banks are not willing to lend. We are able to lend at relatively good loan to values, but with very high returns. So, there are always risks within the portfolio, and I'm constantly going through the portfolio for where the problems are. But there are very great opportunities to be taken from this type of environment as well.
And could you tell us how you deal with currency risk? So do you hedge any currency exposure
Oh,
at
yes.
all?
All currency is hedged back to sterling fully. So we don't take any currency risk at all. So yeah, the majority of the portfolio is in sterling, but we do have euro, we have dollar, we have some Aussie dollar and Kiwi dollar exposure as well. All of that is hedged back to pound sterling.
And the M&G European Loan Fund, why do you hold a position in that, and why is it so hefty?
Well, it's another sector of the private markets. The reason I hold that is simply because there are Chinese wall issues, that it's easier for me to invest through our leverage loan business through a funds rather than choose those loans individually. And I think they're good assets. I think that fund has produced very strong returns compared to the markets, and actually with low risk as well. It definitely aligns nicely with the type of risk profile I'm looking for in this investment trust. So I'm comfortable with the holding there, and it's just a way to get another exposure to a private private fixed income asset class that I wouldn't be able to invest in directly otherwise.
And in terms of you showed the performance chart with some volatility around your target, and a lot of that reflects the mark-to-market losses. But of course, those aren't losses unless you sell. So could you explain to us how do you generally hold to maturity?
Yep. Yeah. So what will happen is some of those examples we have that I showed you earlier, they will be priced according to where the public market is pricing. They will right now be priced below the price where we bought them, but I'm holding them to maturity. So that's only because we're trying to the earlier question, we're trying to mark to market our entire portfolio. There's no particular credit stress in any of those. It's just the marking to market. So we're holding these to maturity. When they return to refinance and to mature, then we'll get our money back, and that will be a pull back to par. So that'll get you back to the benchmark line.
Yeah. So to be clear, in light of another question, it's a matter of the duration there that's causing the mark-to-market losses rather than credit.
There's an element of both. I mean, we're not running a great deal of duration risk here, but there'll be a small amount of duration risk. But credit is trading reasonably wide right now. So that we may have bought those when credit was a little bit tighter, and they've just been marked down because of that.
Great. One final question, unless somebody wants to drop anything in at the last minute. So have you had any defaults in the portfolio since inception? I should probably ask when the portfolio was incepted. And what has been the experience regarding negative credit rating migration?
So in terms of credit events, we have suffered one. This is a long time back. This was occurred during the COVID crisis. We had a small holding in Into, which is a property, a retail property company, which got into difficulties post the COVID crisis. We didn't buy those bonds. These were actually public bonds. We did buy those at a discount. We've since sold the position, but it did go through default. The holding was relatively small, so the total impact on the portfolio was I don't think I can give you the exact numbers, but it was in the tens of basis points, so 0.2, 0.3% of the total portfolio. In terms of rating migration, generally positive. The majority of the portfolio is these private and illiquid assets. These are for most parts internally rated. But as they perform, we will be upgrading them, and they're generally performing very well. So I have we don't have any assets there which are on any problem credit committees at the moment, and I think the general trend is a positive one in the credit improvements.
Fantastic. Well, thanks, Adam, for your presentation. Thanks very much for answering those questions. And thank you for those of you in the audience for your attention. I'd like to remind you that tomorrow we'll be hearing from Edinburgh Investment Trust, and we'd love to see you all there. Adam, thanks very much, and have a great afternoon.
Thank you, Thomas, and thank you for listening.
Bye-bye.
Bye.